Hi, it's Atticus Analysis, and today I wanted to do a little bit of a deeper look on FTAI and different possible valuation models. Someone in my Discord, link in the description below, which is completely free by the way, asked me if I could give thoughts on where exactly FTAI's price target is appropriate given uh, all the stuff that I talked about in my previous video on FTAI. I kind of said at the end I think it should be at least $200, but let's drill down into exactly why I think that and what numbers other people are coming up with. So the first and simplest way to look at this stock is to just look at how fast are the earnings growing? So these are non-GAAP earnings. For some reason, a lot of analysts aren't really doing GAAP projections for this stock. Maybe that's because they're having a transition in the way they do their business model with the FTAI. But yeah, anyway, as of right now, the analyst consensus is that the non-GAAP earnings are set to grow by 42% between 2026 and 2025. That means that if you just multiply that by the price that FTAI was at the beginning of the year, you get to $205. And that I think is kind of the bare minimum for where the stock should go. I wouldn't even necessarily call that a 1 year price target. I would more likely call that a kind of end of the year price target because, and this is very important, that means that the stock's just kind of appreciating along with the earnings. It's not necessarily appreciating because it's becoming a more high quality business. And there are a number of reasons why the business is becoming more high quality and deserves to have multiple expansion. The reasons I mentioned them, like I said, in depth in the previous video, but just to review very briefly, the company is going to be lowering its cost of debt. It's going to be increasing free cash flow, and it will be pursuing share buybacks. And because the FTAI is going to essentially guarantee like a captive market of customers in addition to having management fees and performance fees, that's going to both stabilize the company. It's going to decrease the way in the past the company was reliant on cyclical trends in order to have bursts for earnings, and it's going to increase gross margins because it's going to guarantee a certain base rate of volume because it's going to have access to all these planes to repair. So because of all that, I think that some multiple expansion is warranted, but this $205 price target that I have for you right here doesn't show any of that. It just says, let's have the stock grow with the earnings, and it's a $205 stock if that's the case. BTIG, they put out a target of $230, and effectively what they did was they said 22 times 2026 EV to EBITDA. I'm not a big fan of EV to EBITDA. I know some big legends like it, like Michael Burry. It feels a little bit too wonky to me, but what I like here isn't necessarily the fact that they picked EV to EBITDA or that they slapped 22x. I'm not familiar enough with that particular metric of EV to EBITDA to know if that is considered like an aggressive valuation or not. But what I like about it is the way they are changing it in line with their estimates. So before they issued this price target, they previously had said that in 2026 the company was going to have 2.7 billion of revenue, and now they think that in 2026 the company will have 3.3 billion in revenue. They have then essentially increased the price target from 190 a share to 230 a share on that basis. So in other words, this is a slightly more aggressive target, but once again, effectively what you're doing is you're just kind of having the shares appreciate in line with the multiples that the company is already doing. The revenue estimates are going up, so the share price is going up in the exact same way. It's not getting any credit for improving the business model, it's just getting credit for the growth. So 230 next year, I think, is kind of the bare minimum, but again, I would also say that that is potentially low for an end of the year 2026 price target. Now let's take a look at something that I found online that looks at the different comps here. So as you can see, there's these other companies that do airplane parts, and they typically have an EV to EBITDA ratio of 20 24.5x. Now, FTAI is not at that level at all. If you were to use these estimates, then you would get 274.4 based on this specific way of calculating EVD. But this is a really good example of how I don't think it's consistent, because as you can see here, BTIG arrived at a slightly different evaluation for EV to EBITDA than these guys did. But yeah, if you're trying to essentially give the business some amount of multiple expansion, you're going to end up with a higher number. But let's also think about this from another perspective. So all of these other companies here all have a higher multiple than FTAI currently. They all have about a 90% higher multiple. But the question is, what multiple should FTAI have? Should it be in line with these other companies, or should it be higher? Because FTAI is set to grow revenue and earnings at a rate higher than all 6 of these other companies. So if that's the case, why should it be limited to just getting 274? Or why shouldn't it be higher than that? So if you look at Benchmark's qualitative model, they say 300. Now, they don't do a specific calculation to arrive at 300. Instead, essentially, they just do what I did in the prior video, where I just talked about the SCI and how that's going to improve the company. And they mention all the other things that are helping them out. So yeah, this is an interesting question, right? You kind of have to use a little bit more art than science here in terms of evaluating what exactly is warranted as you think about the multiple expansion. In general, multiple expansion is kind of a one-time thing. It doesn't necessarily, the multiples don't just get bigger and bigger and bigger unless the business quality just improves and improves and improves forever. And I don't necessarily think that's going to happen. I think that FTAI is going to get a very significant jump in price to reflect the SCI model, and that's going to take it to a higher level, and then that's it. And then from then on, it's going to appreciate in line with earnings and share buybacks and things like that. So this is definitely the time to hold it, like within the next year and a half, while that appreciation occurs. But it's not important to figure out exactly what the price target is. It doesn't really matter in the long run whether or not you think that FTAI is going to go to 230 or whether it's going to go to 300. That is a very big range, but it's not important what the actual number you pick out is. Why is that? Because FTAI right now is only 150, so it doesn't matter. If FTAI got all the way up to 200, maybe it would matter a little more, but I would say you could still hold it for the 230 if you wanted. But yeah, like if we were passing 230, if the stock was 250 or 260 or something, then you might say, oh, okay, now it's getting a little expensive. I don't know if I want to hold it all the way up to the 300. Maybe you do, maybe you don't. You can have that debate then. Since we're nowhere near that number, I just don't consider it to be very relevant. I want to get more information. I want to learn, exactly when they're going to announce SCI2. I want to see the guidance raise that they're going to do at the end of the year. Presumably they're going to do another one. They announced that they're going to do another one. I want to hear, when they're going to do their first share buyback, et cetera, et cetera. That's what I want to hear. And then hopefully we'll get more clarity on if we're going to be closer to the 300 or closer to the 230. But even if we just get 230, going from 150 to 230 is still very, very good, especially for a company like this that is becoming a much safer company than it was in the past. So yeah, I hope that helps. Again, it's very important that when you do this, you don't get specifically wedded to one particular number or one particular way of looking at it. All of these different perspectives are they're important for understanding the two drivers at work here. The two drivers being that the business is growing, and also that the business quality is improving, and therefore it deserves, at least in my opinion, a higher multiple than it has right now. And those two things are multiplicative, and that's how you can have a 40% growth turning into a potentially 100% increase in the share price. Maybe the business is growing 40% and also the business quality is going up 40%, and so therefore you have a 100%, and you multiply those two things together. So yeah, it does seem like this is going to be a very significant winner here. There are some people who are going to project a number even higher than 300. That's okay. Maybe other people will do that too. Maybe by this time next year, we're going to be talking about whether the stock should be, 350 to 400, something like that. I don't know. It's definitely conceivable. But for now, I think buy and wait till we get above 200, and then once we do, presumably we'll be having a lot more information and we can make more detailed forecasts of exactly what 2026 is going to start looking like at that time. So yeah, I hope this is helpful, and I look forward to hearing your thoughts in the Discord. Thanks for listening.